Hello, Matthew Bell here, and I am licensed in health and life insurance products, and today I wanted to talk about whole life insurance. In a previous video, I talked about term insurance. In this video, I just like to outline the basics of what whole life insurance is and contrast it with term insurance. As I said in a previous video about term, there's a real contrast between temporary insurance on the one hand and permanent insurance on the other hand. Temporary insurance, just like it sounds, is going to be life insurance that's in place for a period of time called a term, and then after that period of time expires or elapses, the policy is in no effect anymore. Permanent insurance, on the other hand, is insurance that's going to be in place beyond that term. Now, permanent insurance can actually be a couple of different vehicles, but the one that I want to talk about right now is going to be whole life insurance. As the name implies, whole life covers you, in principle, asterisk, for the whole of your life. With any policy, the policy can lapse if the plan premiums are not paid when they're supposed to be paid. So there's a potential for the lapse even in a whole life policy, although there's a little bit of a cushion in virtue of what we're going to talk about in a moment, the cash value. So unlike term insurance, which only covers you for a period of time, the term, whole life insurance covers you for the whole of your life in principle, but also unlike term insurance, which has no savings component or cash component, whole life insurance does have a savings or a cash component. Here's a kind of analogy, and I delivered this the last time in the video on term, but just to summarize it now briefly, there's a contrast between renting an apartment or a house and buying a house. When you rent as a tenant an apartment or a house, you are making payments to a landlord and you do not build up any equity in that house. On the other hand, if you are buying your own home, you make mortgage payments, and those mortgage payments build your equity over time. Equity is the amount of money that you would have essentially after you liquidate or sell an asset and after you discharge your debt. So in the example I gave last time, $250,000 house, let's say that's the market value. Let's say that you owe $200,000 on it. If you were to sell that house, then you would get a $250,000 payout, and basically you would be able to pay off the loan with $200,000 of that, and then $50,000 would be available to you. Many cases, what people would do is use that money to as part of a down payment on another home or whatever. But the equity of $50,000 is the amount of money that you would have after you liquidate or sell the house, $250,000, and after you discharge the loan of $200,000. That's in effect. $50,000 is the difference. That's your equity. Now, whole life insurance has similarly a cash value component. It's not generally called equity in a life insurance context. It's referred to as cash value or cash surrender value, but the concept is somewhat similar in this regard. When you're making premium payments into a whole life insurance policy, then those payments are going towards building up your cash value over time. Now, how quickly the cash value builds is going to be a function of how the policy is set up and various other factors that go into the policy, including how many years you pay on it. Some traditional whole life policies are designed to rarefy the payments or spread them out over a very long period of time. Typically it's the whole of your life as well, for all intents and purposes. And when that happens, the cash value is going to be inclined to build very slowly. But there are other types of funding options available for whole life policies. We're going to get to those in just a minute. And in those cases, when you compress the premium schedule, the cash value can escalate and build much more quickly. And then there are certain riders that even can build the cash value more quickly still. A rider is simply an add-on or an extra that can be part of a life insurance contract. You can think of it like an option package on a car. The life insurance policies have an endowment or a maturity date, and this is the date at which the cash value in the policy is equal to the death benefit. It wasn't uncommon for policies to endow at age 100 in the past couple of decades. Some insurers have gone to endowment at 120 years. for policies that are in effect presently or will be written. That's not an uncommon date to see, and the reason is because the insurers don't want those policies to
endow.
It's designed to pay out at the death of the insured, and so it can be a problematic thing actually from an estate, from a life insurance, and from a legacy planning perspective to have the policy endowed before the person dies. Now, in the past, there were policies that endowed you could have them endowed almost any age. It wasn't uncommon to see policies that would endow at the age of 65, for example. And those policies, at the time they were written, were tended to be designed to supplement a retirement program. However, changes in the tax code have made those kinds of policies less attractive to be used in retirement scenarios, and so those are not as widely seen today. Now, whole life insurance typically has a level benefit and here's another asterisk, or an increasing benefit, and it has level premiums. And the level premiums are nice because there's a predictable cost. Term insurance can have a level premium, but because term insurance only lasts for a period of time, so let's say a 20-year-old purchases a term insurance policy that's a 20-year level term, that person, and for more information on term, I invite you to see my video, that person in purchasing that term policy is going to know how much his or her insurance premiums will be for 20 years. But at the end of the 20 years, if the insurance need is still there, they'd have to sort of re-up, even if it's a renewable term policy, they'd have to re-up the policy at a new premium rate that corresponds with their new insurance age of 40 years old. So the premium will go up for the next 20 years, and if they re-upped again at age 60, again the premium would be increased over what it had been at ages 40 and 20. On the other hand, if you were to put in place a whole life insurance policy at the age of 20, let's say for whatever face value it would be, maybe it's the same as the term in the contemplated example here, or maybe different, whatever that premium is at the age of 20, it's already been factored in that you are going to continue to have this policy for the whole of your life. So the premium, when you get a whole life contract, whether it's at the age of 20, 40, 60, or whenever, when you get that policy, the premium is going to be set for the duration of the contract. And the caveats here would be sometimes there are riders that drop off, sometimes there are options that can be exercised that may affect the premium, but from a contractual standpoint, the premium on a whole life policy, once it is set in the contract, it's not going to be altered. Now, I said that sometimes death benefit increases over time. Some policies, some whole life policies are like that. And this may and typically happens in the case of an insurer that actually pays a dividend. So there's a difference between a participating company and a non-participating company. So a participating company, also called a par company, is a company like a mutual fund insurer that pays a dividend. A non-participating company or a non-par company, maybe a stock company, for example, a stock insurance company, generally does not pay a dividend. Now, for tax purposes, and I am not a tax preparer, I am not an accountant, but for tax purposes, the dividend that an insurance company pays is considered to be a return of premium or an overcharge of premium. Now, there are a couple of different perspectives. For a non-participating company, a person who works for a non-participating company, they're going to say that the insurance premiums that are charged by the participating company are higher than they would be otherwise. That's what allows for the dividend. So the non-par sales insurance person is likely to say that his or her premiums are going to be less than the premiums that you would get charged in the case of the dividend. For those people who sell policies that are eligible for dividends, so participating companies, those people are likely to say that the overcharge is simply a bookkeeping term for the purposes of accountancy and preparing tax returns, and that in some interest rate environments a person can actually, and in the past this was the case, that the dividends generated by the policy can actually be in excess of the premium, And the suggestion here is that this shows that the dividend is not simply a return of overcharged premium. If you can actually get more dividend than you would pay in premium, then it shows that the dividend is disconnected from the premium in some relevant sense. Now, I hasten to add that this would be in some markets, some market environments, and in some interest rate environments. Not in a low, as we sit here and record this video here in 2019, the interest rate environment is certainly not the kind of an environment where we would expect the dividend to potentially pay for a premium. But at the same time, a person has to understand that the dividend calculation is complicated. I'm not going to get into the entire thing here, but there's going to be expense charges that are going to be factored in. The market, certain performance of the insurer is going to be factored into it, and it's going to essentially be a decision that is handled by, let's say, the board of directors or whomever in the mutual insurance company. They're going to have to, based on internal metrics and so on, they're going to have to pay a dividend based upon their bookkeeping. Dividends are never guaranteed, is the point, and there's no sort of predictable, here's the rate at which you're going to be paid. It's not a straightforward interest rate. Now, the types of whole life policy that are available are generally going to correspond to the length of time that it's going to be paid. So there's a traditional whole life policy, often called life paid up at 100, it's generally what it is, and the idea there is that you pay continuously over the course of your life. So when the policy is taken out, it could be taken out at 6 months of age, it could be taken out at age 18, it could be taken out at 25, at 40, at 42 and a half, at 65. Whenever the policy is taken out, the premiums that are assessed with the idea that the person is going to be paying for the entirety of his or her life. Those policies are also called continuous pay whole life. Now, there's also limited pay whole life, and limited pay whole life can be, in many cases, it can be almost any number of years, but very common ones would be, let's say, a 10-year policy, a 20-year policy, life paid up at 65. It's important to understand that what we're talking about when I say a 10-year pay whole life policy, I do not mean that there's a 10-year term on it. This is not term. In term insurance, you'd pay a premium for 10 years for insurance coverage for 10 years, let's say, if your term was 10 years. And after the 10 years, the term would be up, the policy would be of no effect unless the policy could be renewed or unless you got a new policy. But in whole life, if you have a limited pay policy that is a 10-pay policy, then you could pay up an entire policy that will be in force for the whole of your life over the course of 10 years. Now, the amount that you would pay in premium over 10 years is going to be a greater amount than what you would put in over the whole of your life. If you got a life paid up at 100 policy, your premium is going to be lower. If you got a life paid up in 10-year policy, those premium policy payments are going to be compressed over a shorter schedule, so the premiums are going to be slightly higher, but there will be certain discounting that will apply in terms of the total amount that you would be projected to pay into the policy over the whole of your life. The same would apply to 20-pay policies, life paid up at 65. That might be a policy, let's say you get, when you're 30 years old, you have it paid up at the age of 65 so that when you go into retirement, you don't have an additional expense to take into your retirement and you still have your insurance policy. So again, the longer the payment period, the less expensive the premium. The shorter the payment period, the greater the expense. Some of the uses. Whole life has a number of different uses, and whole life actually, since it has a savings and a protection component, the cash value and the death benefit, or the cash value sometimes referred to as a living benefit. So whole life is a combination of a living benefit and a death benefit. So the uses for whole life are going to be dependent on which of those two or both are in view when the policy is put in place. In other words, what is the policy trying to achieve? So for death benefit, if we're aiming at death benefit, then the policy might be in place as a burial or a final expense policy. It might be in place for a pension maximization or pension max plan. It might be in place to help with emergency funds or educational funds in the event of the death of the breadwinner. Now, if we're talking about living benefits, then the policy might be in place as some sort of a tax shelter. It might be that it's trying to have money for, again, for an emergency fund or for an education fund while a person's alive. It might be for savings or for a kind of bank on yourself sort of situation. And it might be in place to open the option for policy loaning, which is a related concept further down the line. There are some special considerations, and some of these considerations are going to apply in specific cases. It's partly dependent on what the policy is designed to do. So we just sort of canvassed a number of common uses. Life insurance can be put to a number of different uses. But depending on what they are, there may be some special considerations. So we talked about how a life insurance policy could be paid over the whole of a person's life or in a shorter period of time. Which option is best is going to depend on your age, your health. It's going to depend on what the policy is being used to do. So in some cases you might think that paying a policy is going to be, it would be advantageous to have the premium as low as possible. And in some cases that's the case. Maybe if you have to watch expenses, so if there's a very young person who wants to have a burial policy in place, you might be able to do that for just a few bucks a month. On the other hand, if you're using it for retirement savings and you're trying to build up the cash value as fast as possible, then the low premium payment is not going to be of service to you in that case. Contrary-wise, if you are older and you want to have a paid-up funeral expense policy, it could be advantageous to just drop a full cash into the thing, or it might be more advantageous to take advantage of a lower premium rate. The limiting case of limited pay is going to be something called a single premium whole life policy. And in this policy, you would make one cash payment. One infusion of cash would go in and the policy would then be paid up. So it's possible to pay up an entire whole life policy with just one payment, and that is going to come at a discount over what the amount of premium that would be expected to be paid into the policy over its life. And again, we have to say this as an expectation because the life insurance company doesn't know when you're going to die. There are statistical reasons and that they can guess when a person's mortality is going to be, and then they go through an underwriting process which is going to involve medical evaluations of the proposed insured. And these two things, the statistical probability after they've fixed what your general health rating is going to help them to have an idea of what your mortality is going to be. But again, there could be an accident or some unforeseen thing might come up, and a person could die earlier or later than they're projected to die. We'll go into underwriting and some of these mortality considerations in more depth in a future video. So some pros for whole life is, number one, it has a predictable cost. The contractual cost is going to be level throughout the contract. You know what you're getting into. You know when or if the policy is ever going to be paid up. And there is the potential to be able to use some of the cash value, not just for some of the living benefits that we just discussed, for retirement planning, for tax sheltering and the like of that, policy loaning, but it's also possible to use some of those values in order to keep the policy alive in the event that, let's say, you run into financial difficulty. So the cash value in the policy is capable of automatic premium loaning, generally speaking, which is to say that the cash value can be used to keep the policy going. Now, it's not advantageous to use it this way in some scenarios, because if the policy is designed to be used as a retirement supplement, then it's not advantageous to use its own cash, because that's going to be counterproductive. However, it's a nice feature because if a person does run into some kind of a situation where expenses go high unexpectedly, or somebody loses a job, it's advantageous to have the ability to keep the policy going so it can be self-sustaining for a period of time anyway. And again, whole life, just as the name implies, gives you coverage for the whole of your life. Now, some cons to whole life is, number one, that the premiums could be owed even after your income producing years are over. So if you have a traditional whole life policy and you retire at age 66 and 2/3 or 67 or whatever, and then you still have a premium payment to make on your whole life policy, you have to factor that in planning, have a discussion with your insurance agent or advisor in order to try to create a plan that makes sense for you, and that fits in with your overall financial goals and your overall financial plan. Insurance is probably not best thought of as kind of an add-on, but rather it's probably best thought of as a feature that should be part of your overall financial and retirement plan. Another potential downfall to this is that if you're going for death benefit, the death benefit bang for your buck in a whole life policy is going to be less than what you would get in term. Term being pure insurance or pure protection, for every dollar you're going to get more death benefit. Now again, that comes at a price tag of temporality or duration. The term policy is going to be limited, but if you're going for, let's say, income replacement, in many cases it might be advantageous to use term for that. Although there are income replacement scenarios in retirement. For example, when a husband and a wife are both recipients of Social Security and one dies, then essentially the lesser of the two Social Security benefits is going to go away. And if you use term for this, it may be that the term policy will have expired or will have become cost prohibitive by the time that one of the spouses dies in retirement, and that there's an actual occasion to use or to need an insurance policy for Social Security replacement. So in that case, whole life might be a little better. But for general purposes, for a younger couple looking to replace an income, let's say a guy's making $100,000 a year, whatever, then for that kind of level of death benefit, a multiple of $100,000, probably going to be term. Now, some people will also say you got to realize that the interest potential for the money that's in a whole life contract is not going to be as great potentially as what you might be able to get in the market in some other vehicle. Now, I'm not licensed to sell securities or equities or any of these other instruments, but it is the case that, let's say, if the market on average is going to return between, let's say, 6% and 10%, or 8% and 12%, or whatever your favorite range of possible returns is, then you look at a whole life policy that may be returning 2%, 3%, 4%, and you might think, well, I can do better on my cash in the market. And that is true. You can, but in some cases you can also do worse in the market. So generally speaking, we think about having it be advantageous to have some of your risk at least spread around. Maybe you have a more conservative part of your portfolio and a more riskier part of your portfolio. Now you can do that with, let's say, stocks and bonds. Some people do that, but you can also include some whole life insurance as part of that overall plan. But again, it has to be funded correctly. Some critics of whole life are quite right to point out that under certain funding scenarios, whole life is not going to be advantageous because the cash value is going to build so slowly. But those policies have not been set up generally for retirement, or if they were set up for retirement, they weren't set up correctly. Now, all of that is going to get into much, much greater detail than what I have time for to go into in this video. So stay tuned for a future installment where I may get more in depth into some of the potentials for using life insurance in a retirement plan. It's usually called a LIRP, life insurance retirement plan, and there are certain applications. But once again, there are many different schools of thinking when it comes to retirement planning, when it comes to investment strategies and just financial planning in general. There are a number of competing perspectives, and so I am simply, in these kinds of videos, I'm simply trying to give you information, and again, this is not to be construed as financial advice or insurance advice. It's for entertainment or informational, general informational purposes only, and it's simply, again, to be used as a resource. I hope that something that I said may have been useful to you, and I invite you to check out future videos. If you did find it useful, I would appreciate you liking the video and subscribing to the channel. Thank you so much for joining me today.